Can we start, sir?
Hi, Parth.
Shall we start, sir?
Yes, please.
Sure, sir. Ladies and gentlemen, a very warm welcome to all of our esteemed participants in today's Investment Outlook webinar. Today we have with us Mr. Alok Chopra, sir. Alok Aggarwala, sir. Mr. Alok Aggarwala, sir, is Chief Research and Investment Officer with Bajaj Capital Limited. He has more than 40 years of experience, research enthusiast, and a follower of Indian market and economy. He's a chartered accountant by profession and likes reading books and following the Indian economy and market. A popular face in media and a prolific writer, he likes to contribute to popular financial newspapers on an invitation basis on subjects related to Indian market and economy. Here are some basic guidelines for this session. We will try to keep this session as interactive as possible. All the queries and questions that you have, you can mention in the chat section or in the Q&A tab on your screen, which will be answered by the end of this session. From here on, I would like to hand over the session to you, sir.
Thank you. Thanks, Parth. Good afternoon and a very warm welcome to all my colleagues, team members, and all other attendees who are there on this call. I have a bad throat. I have been sick for the last 2 days. So my voice may not be very clear, or I may speak at a lower volume. Just pardon me for that. We will keep it as interactive as possible. Please post your questions in the Q&A window. In the chat window, they tend to get lost. Q&A, I will answer each and every question. We will talk about what's happening in the global markets, Indian economy, Indian equities, Indian fixed income, gold outlook, and investment strategies in this call. And then we will take questions and answers. So to begin with, before I share the presentation and get into the technical stuff, I want to talk about certain key happenings in the markets, a couple of strong macro trends that are taking shape globally as well as in India, which could define the next 4 or 5 years of our investing experience. The last 2 months, particularly since first week of September, have been very interesting for global financial markets. A lot seems to have happened in a very short time. We started with a US Fed meet in September, wherein they said that interest rates, the natural real rate of interest in the US economy is actually far higher than the original assumption of 2% that they have been making, right? Which led to a sharp rise in interest rates, because this was a very strong statement in favor of higher interest rates for longer. 10-year G-Sec, 10-year treasury yields in US shot up to close to 5%. Real yields measured by 10-year TIPS yield in US shot up to near 2.5%. And almost all risk assets, they declined. The second instance that happened was the Israel-Hamas conflict, which started on 7th of October. Oil prices shot up to $92 per barrel. Interest rates remained higher. because higher oil prices were supposed to further impact inflation, make it higher, right? And risk asset classes, equities, etc., sold off or went down across the globe. Then there is something that happened towards the end of October, on 29th or 30th of October. So whatever risk of trade that we were seeing, whatever bear market in bonds and equities we saw for a large part of September and October, suddenly reversed. Yields, US 10-year GSEC yields fell. Indian yields moderated in line with them, though not to that extent, but by a lesser extent. Equity markets worldwide recovered very sharply. And over the next 4 or 5 days, or so far, over the next 6, 7 trading sessions, equity markets are up by 5 to 6% globally, back near the level where they were before the Israel-Hamas conflict took place. Very near to that. Oil fell below $80 a barrel. Brent crude, which had risen to 92 plus, fell back to below 80. Yields, bond yields fell across the curve. US bond yields, 10-year GSEC yields came down from 5%, from a high of 5% to around 4.5%. Indian 10-year GSEC yields had risen up to 7.4 plus, which are now at about less than 730, around 724, 25. Right. So what happened in towards October end that all of a sudden everything changed? Is this sustainable? Is this a recovery durable? How will it impact? What's actually happening behind the scenes? How will it impact the various asset classes, equities, bonds, currencies, gold, and what is there for an investor to do? We will talk about that. Before we go over there, as I said, there are a few strong macro, large, long-term trends taking shape across the world and in India, which we will talk about. Let us start with the macro trends. So first is the rapid industrialization in developed as well as some emerging economies. Now, the Western developed countries have understood one thing, and the thing is that they need to reduce their dependence on the manufacturing capacities of China and emerging nations, right? So they are starting rapid industrialization and building manufacturing capacities in their home countries. They are reshoring the work that they had offshored or outsourced to emerging markets. They are reshoring it back, bringing it back to their home countries. Some emerging economies are also rapidly industrializing, case being in point being India, as it gears up to meet the demands of China plus one strategy. So massive investments in infrastructure and manufacturing capacities will give rise to a big boom in these sectors. Let us take an example of electrification. At present, electricity is only 20% of all energy consumption in the world. If we are to become net zero carbon neutral, basically net zero emissions, and use electric vehicles and reduce the fossil fuel usage and all those things, then the share of electricity in global energy consumption needs to rise from 20% now to 40 to 50% in the future by 2040, 50 odd, right? Year 2050. Only then we will be able to meet the net zero pledge, which is important to stop the effects of climate change. All governments are working towards that. Now to more than double the share of electricity in energy consumption, which is already rising in the world. To do that, the global economy needs to spend $1.1 trillion on electricity grid only each year till 2050. So assuming that this data was till 2022, for 28 years, we need to spend $1.1 trillion every year, which means almost $31 trillion in the next 28 years. Just to give you an example of an idea about how big this $31 trillion is, India is about a $4 trillion economy, 3.5 to $4 trillion economy. So it is almost 7-8 times of that, right, in the next 28 years. Massive investments have already started happening in electrical infrastructure, transmission, distribution, grid lines, cables, etc. As per Hitachi Energy, a company working in the power sector in India, it's a global company, a Japanese company. India alone will need to add an equivalent of entire European Union's entire existing grid by 2040. So whatever existing electricity grid that is there in entire European Union, India will need to add a similar amount of electricity grid by 2040. Now we know how big European Union is, how developed they are, what is their energy usage or consumption. So basically in the next, 17, 18 years, India has to add electricity grid, which is equal to the entire existing grid of the European Union, right? This is the size of this trend or opportunity that we are looking at. No wonder that the power infrastructure businesses in India have outperformed. And this is, mind it, this is only in the electricity grid. We are not even talking about power generation plants, solar plants, etc., and other infrastructure required. Can you imagine the size of this opportunity? So we might be in the early stages of a massive infrastructure boom in India and across the world, which will be even bigger than the boom that we saw in the 2003 to 2008 period, when infrastructure did so well. It is far, far bigger than that. And this is just one subsector of the power sector. This was the first macro trend. The second macro trend is the China plus one theme. Now, whatever is happening on the geopolitical front, it means that global businesses like Apple, Samsung, right, like Tesla, they will need to shift away global manufacturing. They are manufacturing factories or chains or supply chains outside China. Now, when they do that, initially we had expected India to be the biggest beneficiary of this shift. We have been talking about it, marketplace is talking about it for the last 1.5 to 2 years, ever since COVID. Though this shift has already started, so far only countries like Vietnam, Thailand, Mexico, Malaysia, etc. have seemed to have benefited the most. The benefits are not yet visible in India's fixed income investment data, capex data, manufacturing GDP as a percentage of total GDP data. It is not yet visible. We may be doing all the right moves, making the right policies, but the on-ground impact is not yet visible. So many people are raising doubts as to whether it will actually happen or not. So I was in Morningstar conference towards the end of October in Mumbai. And there we met, we had the privilege to hear legendary investor Mark Mobius. He said He was talking on the same topic, China plus one theme, and he said that none of these countries in Southeast Asia or East Asia, Vietnam, Thailand, Mexico, or say in Central America like Mexico, none of these countries have the size and manpower resources or other resources to absorb the quantum of this shift. None of them has the geographical size to even build factories or manufacturing plants of that scale. India is the only country that can be a viable alternative in terms of geographical size and manpower. For those still doubting, Mark Mobius said, for those who still doubted the skill of Indian workers, Mark said, if India can cut and polish diamonds, why can't it do semiconductors too? So fine tooling, which is required for semiconductors. Many people say that China has built massive capacities and has trained manpower, and Indians lack in those skills. Remember, we have been cutting and polishing diamonds since ages. We are the world's largest country to do that, right? So if we can do that, which is a much more finer job, we can surely do semiconductors. Also, India is one of the very few large economies in the world that is not engaged in or has not taken any sides in geopolitical conflicts. So whether it was Russia, Ukraine, or Israel, Hamas, or anybody else, we have not yet taken sides in any geopolitical conflict. We have relationships, we have trade relationship, cordial relationship with all countries, almost all countries, barring a few. So India remains a trusted partner for those looking to build resilient supply chains, which will not be disrupted in an ESG compliant manner, climate conscious manner, right? So this is why India remains a very potent candidate, and things will happen. These things generally take about 3 to 5 years to show an impact on the ground. It is not like setting up a BPO in one place, employing 100 people and starting business. A manufacturing capacity, the entire ecosystem has to be built. It takes time, but we are making the right moves. The third biggest macro trend is the decoupling between the two largest economies of the world, United States of America and China. Now, these two economies are or were extremely dependent on each other. In 2016, 22% or more than one-fifth of US imports came from China, while 19% of Chinese exports, again one-fifth, went to United States of America. Such was the dependency of these two economies on each other. And I'm not even talking about the amount of treasury bills that China's central bank used to hold at one point in time. Now it has come down, but it is still $800 billion, which is far more than what India has, right? And other stuff like almost all US businesses having a base, manufacturing base in China and all that. I'm not even talking about that, right? But one-fifth of imports and exports of these two countries were to each other. Now we know in 2016, Donald Trump came and then a trade war kind of started between these two economies. The result is today in 2023, these numbers 22% and 19% have fallen to just 15%. So today, only 15% of US imports come from China, as against 22% in 2016. The percentages may seem small, but given the size of this trade, this could run into billions of dollars. And same thing for China. Earlier, 19% of China's exports were to the US. Now, that number has also fallen to 15%. So 85% of Chinese exports are now going to countries other than US. And there is evidence to show that China is exporting more to BRICS and Africa than to G7 countries, the developed Western world. And at the same time, we have seen that the G7 countries or the Western developed markets are reducing their dependence on China by building capacities and infrastructure in their home countries. Correct? So now, So basically, the dependency is reducing. Now, why? What does it mean? So we know that for decades, for 2 to 3 decades, developed markets, America, Europe, Japan, they continued to run huge trade and fiscal deficit for years, for decades, and extremely loose monetary and expansionary fiscal policies for decades. And yet, they also used to have low inflation. Now, all of these things cannot go together. You can't have huge deficits, you can't have loose monetary and fiscal policy, and yet have low inflation. That defies logic. But they did it for 2 to 3 decades. And the reason was because China was exporting deflation to them. They had outsourced their manufacturing to China. Now, China used its massive factories, cheap labor, improved productivity, and a cheaper currency manipulation, remember, to produce and export these goods at a very reasonable cost to the Western developed markets. Because China was doing this, prices in US or developed markets did not rise, right? Because China was always ready to do that, give cheap goods, uh, which were cheaper because the currency was also controlled by China. Now, if this dependency reduces, if China exports less to these developed markets, or these developed markets import less from China, then what happens? The export of deflation from China to US or Western markets will stop, which means prices will rise, which means inflation will come back in these economies, right? Inflation should remain high and for long in developed markets, because this is not going to change. It's a structural shift. And add to that the fact that their finances are in bad shape. Their growth is slow. Western economies, 3.5% is like God's gift to them. They run big fiscal deficits, big trade deficits as of now. Will they be able to bear the shock of higher inflation? Also, the US Federal Reserve, which is like RBI in India, is running a quasi fiscal deficit since September 2022, more than a year. Now, what is a quasi fiscal deficit? Quasi fiscal deficit happens when the interest earnings of the central bank are lower than the interest that it has to pay on the liabilities that it holds. Correct? So negative P&L for the central bank is what we call quasi fiscal deficit. Now we know, we have heard in the media and in through various people, RBI ने इतना dividend देगा इस बार government को, RBI is going to give this much of dividend, these many thousands of crores of rupees of dividend to the government, which will help in fiscal deficit. So RBI earns profits and it is duty bound to share it with the government as dividend. What if RBI was not earning income, was in losses? How would it give? Then it will need refunding or refinancing from the government, right? The US Fed is in such a situation. Its expenses, interest expenses, are more than its interest income. Now, history shows, and it has been doing so for more than 1 year. Now, historical evidence shows that whenever any country's central bank has run such a quasi fiscal deficit for some time, this has led to hyperinflation in that country. This has happened with many countries in the world, including in US itself. Way back in before the US Federal Reserve came into the picture, I guess that was the 19th century, the early part of the 20th century or the end of the 19th century. Some continental or some bank. So they were running a quasi fiscal deficit and then the bank collapsed. There was hyperinflation in US, right? And there are many Latin American countries also, which are prime examples of this. All of them saw hyperinflation in the 1980s, 1990s, etc. So, with US Federal Reserve running this kind of a quasi fiscal deficit, is the US economy and along with it the rest of the developed world, because they're interconnected, moving towards higher for longer inflation and interest rates? Then everything changes, because high inflation, high interest rates, volatile currencies, all of these, and risky equity and bond markets, all of these have been historically been associated with emerging markets, not developed markets. Right? That is why emerging market currencies, bonds, and equities are called risk assets. They carry higher risk, right? Because they have higher inflation and high interest rates. They are vulnerable to the capital flows from the developed markets. Developed markets have historically been suppliers of capital and technology to emerging markets, right? And the movement of this capital in and out of an emerging market creates the cycles of booms and busts, bear phases and bull phases, creates imbalances, crisis in those markets. Whether it's the Asian currency crisis of 96-97, prior to that, the whatever crisis we saw in India in the 90s, after which we opened up as an economy, or the global financial crisis, the overheating of the global economy, all of this, or most of this, is caused by the flow of money in and out of these emerging markets, right? So developed markets have historically been suppliers of capital. Now, after COVID, we have seen this reverse. Correct. Now, their developed markets have had higher inflation. Their currencies have been weaker. I'm not talking just about the dollar, but look at euro, look at Japanese yen. In 2016, Japanese yen was 104 yen to $1. Now it is 150. Right? Look at euro. What has happened to that? And developed markets are also seeing sharp rise in interest rates. See, US raised its raise from 0.25 to 5.5, almost 500 basis points, more than that. India raised rates by 250 basis points only. The repo rate before the rate hike started was 4%. Now it is at 6.5%. That's it. Right. So now what used to happen earlier with emerging markets is now happening with developed markets. So are developed markets becoming emerging markets and emerging markets becoming developed markets? Because emerging markets this time after COVID are in a much better position than developed markets. Emerging market inflation has been controlled. India has seen far less or almost same inflation in the post-COVID after as US. Actually, it has been lower. This has never been the case in history. Chinese inflation is very well controlled. Interest rates in India are lower. The spreads between the 10-year G-Sec yield in India and 10-year G-Sec yield in US, as well as the repo rate in India and Fed funds rate in US, are historically low, right? And so is for economies, all other economies. Actually, the 10-year G-Sec yield of China is far lower than that in US. Right? It is at about 3.25 or 3.5, whereas US is about, if I remember correctly, 3. But it is around less than 4. Whereas US was at 5% recently and is now at 4.5%. Right. So emerging markets are much better. Their currencies are more stable. See how dollar has euro, what has happened to euro, and compare what has happened to rupee with that. Look at yuan, how it is behaving and all that. Right. And that too in a period when the global economy and trade is so volatile with so many geopolitical conflicts and commodity price rises. It's truly surprising to see the emerging markets holding up so well. despite US rates rising to 5%. The last time it happened in 2008, all emerging markets went for a toss, along with, of course, the developed markets. But emerging markets had a much wider impact, right? And now China is emerging as the new provider of capital through the Belt and Road Initiative. We have read multiple things on debt trap diplomacy by China, etc. All said and done, these are opinions. But the fact is that now China is supplying capital to the world. Maybe not to developed markets, but to BRICS, Africa, and other emerging markets. So it's substituting the Western economies, which were traditional financiers or providers of capital. So now, as China provides capital and China's interest rates are lower, correct? At least domestic interest rates are lower. So it can provide this capital at a better rate. And it is also opening up its factories to the emerging world by exporting more to these emerging countries rather than to Western countries. So with China emerging as the provider of capital and goods to the emerging markets, mainly BRICS and Africa, is this going to be the new normal going ahead, that developed markets will have higher inflation, higher interest rates, and more vulnerable equity markets and currencies, versus emerging markets, which will be much stronger? If that is so, then a lot of things will change, right? And they will become clearer with time. So I will stop this topic over here right now. Just gave some food for thought to you as to the emerging trends across the globe. Indeed, these are very interesting times to live in, because we are seeing a shift in global economy, global geopolitics, global alignments, a lot of that. Very interesting times. Now let us come to the more immediate things, right? And to, of course, the PowerPoint presentation also, so that we can get slightly more technical, right? Okay, I guess my screen is visible. So this is basically the PPT. I'm sure it would have reached to almost all of you. We are sending it through BCL Research. If you haven't received it, it will be sent by today evening, right? So we will talk about all the aspects. So let's begin. So come back means we spoke about three things that happened in the last 2 months. The US Fed monetary policy in September, after which yields rose very sharply, right here. This is September. This was the US monetary policy over here. And see after that the rise in yields, right? The 10-year GC yields. It went up to 5%. So it went up to 4.8 earlier, then it came back. And then this Israel-Hamas conflict happened and it shot up back to 5%, right? So the first event was this September US policy. The second event was Israel-Hamas conflict somewhere around 7th of October over here. And the third event happened somewhere around this time, at the end of October on 29th or 30th, after which you see the yields fell very sharp. And not only yields, if you see oil, right? This is oil. Oil rose very sharply from July onwards. This is Brent crude till about September middle. After that, as US raised rates, as the rates in US went up and threatened global growth, oil collapsed to 84 from 94 or 95. Correct. And this is when Israel Hamas happened. It went back up, but did not go beyond the previous high. It was looking to go. But then again, something happened around this time, towards the end of October. And oil literally collapsed, and it is now below the level when Israel-Hamas conflict started. Correct? Below that. So what happened? So somewhere we see there are three pivotal things or key trends that happened in the last 2 months. September US monetary policy, Israel-Hamas conflict, and then something around end of October, which led to, so this is end of October, right? See, this is what we call, so basically this is Emerging Markets Index, MSCIEF, the blue line. The purple line is basically the Developed Markets Index. And the green line below is emerging market bonds, right? Emerging market bonds. So you see, all of them were declining from July, right? They peaked around July and were declining. The bonds and emerging market as well as developed market equities. As policies stuff was happening in US and other places. But come end of October, and all these three asset classes and many others, they changed. They started going up. Now, these are classic risk assets, equities and emerging market bonds, right? All of them started going up. They changed direction and started going up, and it was pretty sharp. What happened during this time? Now, many people say US Fed held rates. So, markets thought that now the next thing that they're going to do is cut rates, and hence yields fell. No. If you see US Fed statement on November 1st, and believe me, this was on November 1st, markets changed gears on 30th of October, right? 2 days before. And what did the US say in its November 1st policy? And this is exactly the US Fed policy statement, right? Which begins with recent indicators suggest that economic activity expanded at a strong pace in the third quarter. Job gains have moderated but remain strong, and unemployment rate has remained low. Inflation remains elevated. The committee remains highly attentive to inflation risk. So even though they held rates, this is by no way a dovish comment. Right? So what exactly then led to that change? Because it all started with bond yields coming down and everything else just followed. It was the US Treasury, right? Now, US Treasury is that branch of US government which basically manages the government's finances, right? The US Treasury came out with a borrowing plan for 2 quarters, November to January and February 24 to April, next 2 quarters. And they said the US fiscal deficit is expanding, their borrowing plan is going up, and that is one thing that had created problems for the bond markets. The yields were rising, right? And the demand was less because other central banks were not buying. Their own banks had an issue. They were already holding into deep losses on their portfolios. So supply was huge, demand was not there. So 10-year GSEC yields shot up. What they did around this time, when they declared the borrowing plan for next 2 quarters, was they said we will not borrow at the longer end of that curve in 7-year, 10-year, 15-year, 20-year, or 30-year papers. We will borrow, but the incremental borrowing, the extra borrowing, we will not do over there. We will rather concentrate it either through T-bills, which are less than 1 year, or at the very shorter end of the curve, which is in the 2, 3, and 5 year segment. So we will borrow short term rather than long term. What it meant was, moreover, before I come to the next part, moreover, there were $100 billion of maturities coming up. It happens in India also, right? Our net borrowing and gross borrowing calendar, the difference is maturities. Similarly, there were $100 billion of maturities coming up in the next 1 month, and they will be paid through 1 month and 3-month T-bills. Now that's crazy, because again, after 3 months, they will need to refinance them. Who does that? But they did it. The reason why they did it was they discussed it between themselves that, see, so far we have been concentrating supply at the medium to longer end of the curve. But the traditional buyers at that point in the curve are basically foreign central banks, global foreign investors, and our own banks. Correct? They buy those longer dated securities. Now, the problem is because of geopolitical conflict and whatever else, almost all global central banks, or most of them, the large holders, they are not keen on buying more US treasuries that are longer dated, right? China, Russia has already stopped. China is reducing selling US treasuries every month. Uh, Similarly, Japan doesn't have, means the surplus has to expand for them to be able to buy, right? Right now, Japan is busy selling dollars to defend its Japanese yen, which is at 150 yen per dollar. So basically, the demand is not coming from foreign central banks or foreign investors. And the domestic banks in US already have a lot of longer dated US treasuries. And they are in deep losses because interest rates have been rising. So they have huge M2M losses, right? So demand is not there. So where is the demand then? Demand is from hedge funds, from households, and from money market funds in US. But they are price sensitive buyers, right? They will buy your bonds only at a price. They are not going to put money in 2% yielding bonds. They need a certain level of yield. So the term premia, the required incremental return to hold a longer dated maturity paper went up, right? So US Treasury found that since there is a demand at the shorter end of the curve from domestic guys, let us concentrate the supply over here and not disturb the longer term yields. And this is only for 2 quarters. Now, when they did that, 10-year GSEC yields or the longer term yields, which were factoring in a huge supply and lower demand, they suddenly saw that the extra supply is not going to come. So demand will basically match supply. And hence the risk that they had built in at that part actually vanished. The term premium, that is what we call, right? It vanished and the yields fell. Also, they could see from the US Treasury minutes, the discussions, that the US Treasury was not comfortable with 10-year GSEC yields going beyond 5%. So they did this. So there was an underlying implicit assumption that if the US Treasury is not comfortable with 10-year GSEC yields going beyond 5%, maybe the government will defend the 5% mark on 10-year GSEC yield, like Japan is doing since 2016. What we classically call the yield curve control. I will basically put a cap on a bond's yield and not let it go beyond that, right? By being an unlimited buyer at that price. Correct? So it is like I will not let Infosys fall beyond, say, hypothetically, 1,000 rupees per share, because anybody who wants to sell it below 1,000, I am the buyer and I have unlimited resources. So there is a floor that I put in, right? It is like the same thing that they did for bonds. This is what market thought. So that now everybody was shorting. We remember Bill Ackman famously coming on social media and saying, "I'm out of my shorts. I'm creating longs." And the entire hedge fund industry was massively short on bonds. Now, with this action, they had to run for cover. They had to cover their shorts. And we know short covering rallies can be explosive. And that is what we saw. Gap ups, gap downs. It was like crazy the next few days. So this is what has happened and led to lower yields at the longer end of the curve. Nowhere did the US Fed come and say that we have changed our outlook. We are not worried about inflation. Inflation is going to come down. Growth is collapsing. We will be cutting rates. We will not hike rates anymore. Nothing. It is just one simple thing that has done it. Now, the market thinks that the US government will now put a cap on 10-year GC yields at 5%. So beyond 5%, they will keep on infusing unlimited liquidity into the market by being the buyer of last resort for those 10-year bonds, right? So liquidity creates fundamentals. So they thought that the liquidity infusion is happening. So let's buy all risk assets, right? Secondly, why did oil fall then? US yields is understood, but why did oil fall? Now, oil, somewhere the fall in oil or the rise in risk assets, maybe they are factoring in the expectation that the Israel-Hamas conflict will not escalate into a broader regional conflict. That Saudi, Iran, etc., they are not going to fight within themselves. They are not going to take sides, and it will largely remain contained. So Israel did ground offensive, nobody reacted, right? Even their hostage negotiations are going on. So whereas there has been a lot of talks, Iran saying something, Falana and Imkana, but there hardly been. US has basically come into the picture. It took that month or so, 20 days, to bring in its aircraft carriers and Marines landing over there, to bring in fighter planes, bombers, etc., to basically show a strength of support for Israel and to deter Iran and anybody else from escalating the conflict, right? So market thinks that it is contained and it will not spread into a contagion and will not lead to a broader conflict in the Middle East region. So there is no threat to supply of energy slash crude oil. And hence the risk premium that was built into oil prices after the conflict went off and oil prices fell, and they fell lower than pre-conflict levels, because what US is doing will be detrimental to global growth, right? And we will see why. So this is now one of the effects of this was the US yield curve, which was uninverting. It was inverted 10 minus 2. It was uninverting, basically, going to become flat, again started inverting because the 10-year GSEC yield fell, whereas the 2-year GSEC yield, where the supply is now concentrated, did not fall as much. So basically, the yield curve started inverting again, right? What does an inverted yield curve mean? Slower growth, recession in the US economy, right? Slower growth. Remember that. Now, inverted yield curve also means uh, uh, basically a pushback in equities and global risk assets, a temporary liquidity driven. But the fact is, how long can this continue? All risk assets are basically growth assets, equities, right? They are growth assets. How does a growth asset do in an environment when growth itself is slowing, when there is a risk of recession as shown by an inverted yield curve? It may lead to small bear market rallies, but a sustained bull market is not possible on the back of interest rates being cut. Otherwise, there would have been a bull market in 2008 and 2009 when interest rates were being cut from 5% to 0% in US, right? Let us look at oil. Now, oil, classically, these are technicals. Oil bounced back from, so oil basically went up, came back into this range. We explained that last time. But this yellow line was the POC. It was a crucial level. It had to close above this to sustain upside. But somehow it touched this line, took resistance over there and came back. And it's now going towards this $77 level, which is the value area low, right, of this last year's range. Now, this is a crucial support. If it is goes below 77, I don't know what the price is today, but I saw it was less than 80. If it goes below this and stays there for a couple of days, then it could be headed lower, right? So this is oil. Of course, it would be bullish for India. Rising oil prices are never good for India, right? So let's see how it pans out. What is yield curve control? What does putting a cap at 5% mean? How does it impact asset markets? Let us look at what happened in Japan, right? Japan is doing yield curve control, what US is planning to do now since 2016. In 2016, they began their yield curve control by targeting 10-year yield at 0%. They said we will not allow 10-year GSEC yield to go beyond 0%. They urgently needed inflation. They were in deflation. See, this is their inflation, CPI inflation. It was less than zero. Japan has been suffering from deflation since long. They desperately need inflation. For that, they have kept negative interest rates also, but that didn't help. So finally, in 2016, they started yield curve control. Right. What happened after that? Inflation rose for some time, right, up to 1%. In the meantime, the Japanese yen, it was at about 100 when yield curve control started. It depreciated to 116 immediately and then rose slowly, gradually, right, over here. This is Japanese 10-year G-Sec. This is the spread between US 10-year G-Sec yield and Japanese 10-year G-Sec yield. The spread started rising, which means US yields were more attractive than Japanese yields, right? Started becoming more attractive. And inflation was also rising. So negative interest rates in Japan, because inflation was higher, their 10-year G-Sec yields, they kept at zero. And US was providing better opportunities. So their currency, you see from 100, it started depreciating. Then after 2019, this was a period when inflation actually started moderating, right? And even US yields, the spread started coming down and then COVID hit. And the spread of US 10-year G-Sec yield minus Japanese 10-year G-Sec yield started coming down to almost 0.5% because US cut rates very aggressive. During this time, Japanese inflation also came down because all commodity prices collapsed. And Japanese yen actually appreciated back against the US dollar. This went on till 2021. In 2021, inflation started coming back again with the recovery, supply chain issues, commodity prices rose, energy prices rose, food prices rose, metal prices rose, everything was going through the roof, right? As inflation went up, Japan was still doing yield curve control. It was not allowing 10-year G-Sec yield to go beyond 0%. But the market was revolting. The Japanese investor said, why would I put money in a bond which yields me 0% when inflation is there positive? So I get negative real interest rates. And why shouldn't I invest in US, which where the 10-year G-Sec yield had started rising now again, right? The spread is going up after COVID. It has started going up. It is at 1.5% now. So they are getting 1.5% more, right? In US, why wouldn't they invest? Why would they invest in Japanese 10-year G-Sec, which is yielding negative real rate of return? So money started moving out of Japan and going into the US. And the result was Japanese yen depreciated from again 104 levels to 148, 49, 148 levels by the end of 2023. By the end of 2022. Such a sharp fall in currency. Now, when currency falls, Japan again is a net importer of energy. Inflation goes up further, right? Because the energy imports, the prices go up. Correct? Which leads, so higher inflation again, which means again negative real interest rates. US kept on raising rates. Japan could not raise rates because the growth was not yet coming in. In all this game, the primary purpose was to kickstart growth, but that did not come in. Currency collapsed. 10-year G-Sec yield in Japan went higher, but US yields went faster. And inflation kept on going up. So exactly the thing that they didn't want was happening. Correct? And what happened? Here, Japan was forced. Here, they were targeting 0%. In 2000, July 2018, they had to bow before the market and say, okay, fine, we will allow even 0.1% 10-year G-Sec yield, we will allow. By 2021 March, they allowed 0.25% 10-year G-Sec yield from zero. They were raising their cap because the market was revolting. Their currency was depreciating like crazy. In December 2022, they raised the cap to 0.5%, and recently they have raised it to 1%. And 10-year G-Sec yield in Japan is at 0.85%. So, was Japan successful in doing yield curve control? Because if it was successful, right, then its inflation would have been contained, its currency would not have weakened and worsened the inflation situation. It wanted inflation but did not want it beyond 2%. Inflation went up to 4%. Growth moved hardly from 0.8% in 2016 to 1% in 2022. So no impact in growth. 10-year G-Sec yields, they could not keep it at 0%. It eventually rose to 0.85%. So what did they achieve? Their currency weakened, inflation went up, interest rates still went up, growth did not. Now, if US is doing the same thing, what results do we expect? US dollar to weaken, currency has to weaken because money will move out. As US dollar weakens, inflation will come back, will get higher. As inflation goes higher, interest rates will move higher, longer term. So if interest rates move higher any which ways, then what is the point of trying to cap them today at 5%? It is for a very short term period that they are doing it. They think that the US Fed will cut rates next year when all these papers, short term papers that they're issuing today, will come up for refinance. Right? Now, I hope that they are right and the US Fed actually cuts rates, but as of today, there is no such evidence. And if the conflict, so Middle East conflict is not yet dead, right? It is like that volcano, which is active but not yet spouting lava. That's the only thing. It is not yet over, correct? If that happens and energy prices shoot back up, God help the US Treasury, because I don't think that the US Fed will be cutting rates there, because inflation would have shot up, right? So I will miss some of these things. You can always read it later in the presentation. Inflation is basically moderating, but at the same time stabilizing. It has moderated in most of the developed world and India and China as well, but it is now stabilizing. The high base effect has now gone, is now gone, and the low base effect will come into play. So we believe that now it will stabilize, right? US interest rates have changed structurally. They are in an uptrend, right? Whether it's the policy Fed funds rate or the 10-year G-Sec yield, even after the fall from 5 to 4.5. See, this is but a mere blip. How far they have risen? See, the 10-year G-Sec yield. See, what is this? Just a blip, nothing else. Structurally, they have broken out of this trend, downtrend. So our hypothesis, DMs becoming EMs, higher inflation, higher interest rates, higher for longer, right? So all of these are technical again, US real yields and nominal yields, right? I have already discussed this. Why do we think inflation and interest rates will remain higher for longer in developed markets? The chances of uh, hyperinflation, etc. We have already discussed it initially. How China will become the provider of capital to the world and uh, factory, and whereas Russia will keep on providing natural resources, not to the West, but to the emerging world. So the West will find natural resources costly, manufactured goods costly, higher inflation, higher interest rates, slower growth, large fiscal deficit, government finances in for a toss. They are really in for some hard times. Emerging markets will be better off. But India, how will India benefit? BRICS will benefit. Africa will benefit because China, they will take loan from China at cheaper rates, import goods. There will be a boom. India, India already has a negative trade balance. India perceives China as an enemy. It will not borrow money from China. India will have limited benefits. India's capital providers is the West, and the West's cost of capital is going up. So hold on, I'm not saying doomsday for India. Things change, but in the short term, India may face difficulties because of these things, right? So we have spoken about this weaker dollar, demand supply mismatch in US treasuries, and these chances of hyperinflation and what the treasury did. We have spoken all of this, right? Coming to India, growth remains strong as of now, though the PMI indices, which are lead indicators of growth, have started rolling over, coming down, moderating. But the lagging indicators like IIP and core sector output, they are strong because they're lag indicators. They're showing August, September growth, right? Any which ways, that growth was strong at that point in time. But people feel happy looking at these numbers. It makes for good news headlines. Consumer sentiment is moderating. right? It's going down. This will impact consumption. So be very careful about consumption stories. And one of the biggest reasons why people are worried about consumption is because of higher prices. This is the biggest contributor. Income, spending, employment, all is good, right? But the black line, it's price level. This is dampening the consumer sentiment the most. The external sector, our exports, our trade balance narrowed in September because imports fell very sharply, whereas exports fell by a lesser margin. Our exports, though, are shifting gears. They are going down in value terms, but they are going up in volume terms. Gems and jewelry is degrowing, contracting, whereas and agricultural goods, our true traditional export things, are not growing. They are actually contracting on a YOY basis. But electronic goods is growing. So all those talks about Apple and Samsung manufacturing mobile phones here, this is actually being seen. We are exporting more of this. Chemicals, right? Engineering goods, we are exporting more of that, iron and steel. So we are seeing growth over here, both in terms of value and volume. What we see going down is agricultural goods, gems and jewelry, to two traditional contributors, and chemicals in value terms, not in volume terms, right? So things and services exports are improving, though it's we don't know whether it will sustain how long if global economy weakens, because the largest consumers of our services exports are the Western world, right? Where there are issues. So overall picture is mixed on the external trade front, but don't expect much from here. Domestic consumption is any which ways, sentiments are low, so it will. We have seen rural consumption is pretty low, urban consumption is also peaking out. So consumption, external sector not doing great. Capex, infrastructure, this is one area where we have a lot of hope from. And this is what will drive growth going forward. Central government pitching in, state governments pitching in, private sector capex announcements as percentage of GDP is the highest since 2012. Though we are not yet seeing that translating into GFCF growth, gross fixed capital formation growth in GDP data, but I'm sure that comes with a lag. But the sentiments are very good, the announcements are very good. So capex is the story that's going to drive us. Infrastructure, capex, manufacturing, right? The core sectors, power, we spoke about that power sector macro trend, right? All of this, they seem very attractive. Inflation has moderated, come down. CPI inflation, because food prices moderated, it was at 5%, right, in September. And WPI inflation continues to be almost zero, slightly lower than zero. So this was economy. Nothing changed much from the last month when we had this call. Growth is slowing down. Inflation is in control. Deficits, external sector consumption, they are all slowing down. Deficits are where they were last month, no changes. Equities, sales growth, September quarter, 5%. See how it has come down from 35, 29, 18, 13 to 5% for two consecutive quarters. Whereas EBITDA growth expanded 12, 22, 28%, right? PAT growth went up 11, 16, 32, 37%. But how long can your profits keep on rising when your sales are growing at a much slower rate? Means there is a limit to margin expansion. You can't have all your input costs go to zero, right? You can't have 50% margin in all businesses. So somewhere, whatever improvement we had to do from margin expansion is almost at its peak. Now we need higher sales growth, but that is not happening. And with global growth slowing down, even India's own GDP growth expectations in the near term being moderate, we don't see this sales growth going up very soon, very sharply. So this will start having an impact on EPS growth or profit growth, which will then make the valuations, which are slightly above fair value today, become unsustainable. High interest rates, slowing growth, expensive valuations. This does not remain so for long. So somewhere this will have to moderate. That slight derating that we expect is likely to come in the near term. So whereas the medium to long term outlook for India being a growing economy remains extremely good, it is the short term that we are concerned about because the valuations do not reflect this reality of higher interest rates and slowing growth. So they may correct, thereby giving us a better opportunity. But as investment managers, as advisors, it is our duty to ensure better risk adjusted returns for investors. So if we see equities not doing very well in the short term, then we need to diversify. We need to make sure that the impact of any correction, if it happens in equities, is reduced on the client's portfolio, right? Because that is when he starts valuing our advice. We can't go to him every time and say, it's a great time to buy equities, keep on buying. He doesn't need that, no? He doesn't need us. Our job is to ensure that risk is also reduced in his portfolio, correct? And the way to reduce risk is through diversification. So at the current valuation levels of about 21 PE Nifty 50 and a 3.4 times price to book value with an average ROE of about 14, the expected returns in the next 3 years from Nifty 50 with through empirical evidence it has been seen is approximately 9%. It can be higher, lower, but the average is 9%, right? The average return. But there are so many high quality bonds that give us 8 or 9%. Why would I take the risk of derating and all that volatility in equities to get just 9%? So it makes sense for me as an investor today to diversify my portfolio across all the three asset classes, which is equity, debt, and gold. And not just 5-10% diversification, meaningful allocations. Correct? And these valuations of 21p is actually more expensive than it looks because 35% of this is banks. Now, banks P ratio is 16, but banks are never valued on P ratio. So the rest of the 65% of the index is actually P ratio is around 24, which is pretty expensive, even by our long-term standards, right? So slowing growth, higher interest rates, expensive valuations is equal to lower returns from equities in the short term. Correct? Now, if markets, God forbid, tank by 20% in the next 3 months, then of course at that point in time they may become attractive because then the expected return goes up because the P ratio comes down. Correct? At that point in time we may go and buy. But at these levels, with these kind of ROE and interest rates, it is important to diversify across asset classes. Gold, we can easily expect 8-9% returns. It can be even more if gold goes into a bull run on which we are extremely confident. Fixed income is already providing 9%, 8.5, 9.25, good quality bonds, right? You don't even need to go for junk bonds. So why not diversify? Correct? These are capital flows. FIs have been selling since September. In October, they sold 24,000 crores. Mutual funds put in 20,000 crores. That's a separate story. Our SIP book itself is 16,000 crores, right? FDI inflows have slowed down drastically. So somewhere we will you see this Western world in trouble, cost of capital rising, inflows into India slowing down. This story will play itself out. So we need to be a bit careful. Though we have enough mutual fund inflows in the form of SIPs and etc. to balance those FPI's outflows, but believe me, it doesn't always happen like that. See this period, January 22 to June 22. FIs can sell even 50,000 crores in a month. Your SIP book is 16,000 crores. Lump sum flows may at best be 5-10,000 crores. Half of what FIs have sold in June 2022. So we have to be careful. We don't have to be scared and sell everything in equities and go away. No. We need to have the right asset allocation. That will help. You know why dynamic asset allocation funds or balanced funds or multi-asset allocation funds give better risk-adjusted returns than equities in volatile times? Because of asset class diversification. The same thing we have, right? Mutual fund inflows and all that. We have been through this data. We have looked at SIBOs. Now look at Nifty charts, slightly technical. The same chart I had shown last month also. Since 2007, there have been 3 periods when Nifty 50 in rupee terms, what we know Nifty, right? 19,000 plus levels. And Nifty 50 in dollar terms, Nifty 50 divided by US dollar INR rate, divided by 85 or 83, whatever. These two, whenever there have been 3 periods when these three have diverged, which means Nifty 50 in rupee terms, the blue line kept on making new highs, right? Between 2008 and 2015, it crossed this level and then went on to make new highs in 2014 itself, 2013 end of 14 itself. But Nifty in dollar terms, the orange line, did not make a newer high till 2017-18, right? Only towards the end of 2017 or second half did it make a new high. So there was a divergence. What happened? There was a divergence here. This made a new high. This did not. There was a correction. Same second divergence happened here between 2018 to 2020. Nifty 50 in rupee terms kept on making newer highs, higher highs and higher lows. Nifty in dollar terms did not. A crash happened. We can attribute that to COVID, but crash happened. The third divergence is happening now. Since September 2021, Nifty 50 has kept on making new highs. You can see the blue line going up, higher highs, higher lows. But the orange line, Nifty 50 in dollar terms, divided by the rupee dollar rate, has not yet made new highs. It is kind of flat. Again, the third divergence. In the previous two divergences, we have seen a sharp sell-off in markets after a point. What happens this time around? I'm not saying everything is going to fall apart. We will have another 40% drawdown like in COVID. That was a different time. There was COVID. This time we may not have COVID. We may have something else. I don't know. But risk reward. Investing is not about certainties. Investing is about probabilities. Risk reward matters a lot in probabilities. So what is the probability now? Right? This chart is being shown so that you understand what is the probability now. This is short-term monthly chart of Nifty. Again, the earlier support of 19,400 on futures, October futures, is now 19,500 in November futures, and that is now acting as a resistance. Market November futures need to close above this level for the uptrend to resume. Till that time, it remains a bit risky. So we have seen markets for 2 days struggling, remaining at 19,500 range. I'm talking about November 2023 futures, not the spot index, which is at about 19,400 plus, right? So till the time that happens, there is some doubt if it can reverse, right? So that is at that. Last time we spoke about 19,400, we spoke about the risks. The market broke 19,400, the October futures, and fell very sharply to 18,800. We all remember that. But then at 18,800, they found support at VWAP since July, this uptrend since July. The VWAP was here, right? They found support, this green line, and they are now retesting the value area high of this balance at about 19,500, 550. So this is a crucial range. What Nifty does over here will determine the near-term direction. If it goes above this, the uptrend resumes. If it doesn't, if it fails here, then it may come back to 18,400 or 18,500 range, 18,450 to be precise over here, the yellow line. So this is the short-term stuff. Mid caps, very expensive as compared to Nifty. At the upper end of the regression channel, multi-year regression channel, we know what happens. This is mid caps divided by Nifty chart. We know what happens once mid cap to Nifty ratio reaches this level. There are years of underperformance by mid caps, right? So be very careful of buying mid caps. It's easy to get influenced by past returns, but remember they will always be in the past while we invest in the future. Same for small caps, though in small caps there is some way to go before it becomes expensive. It was expensive at this point also. It is one standard deviation, but then it went up back. So now I believe that it's going to go up to this upper end of the regression channel. So still some room to go, but would you really look to like to take that risk? Because large caps look much better against mid caps and small caps at this point in time. Sectors that we like: infrastructure, multi-year bottoming out pattern, broken out, outperforming Nifty, right? Way to go, believe me. And with whatever we discussed earlier about infra investments and all that, this could just be the beginning. This could be a multi-year bull run in infra, manufacturing, core sectors, capital goods, etc. Uh, Similar to what happened in 2003 to 2007, probably or even much bigger, because this time the stakes are bigger, right? This is pharma, looks very attractive after a multi-year downtrend. It has done nothing, loitering at the base, forming a strong base. Recovery is due. Automobiles, look, the risk reward is good, right? Momentum may be slightly uh, weak, but nevertheless, it's still slightly undervalued as compared to Nifty 50. So still remains a contrarian bet and a good opportunity, but the scope is not much, right? Bank Nifty. So I thank my dear colleague Amarnath for pointing it out to me on a phone call and then on email. He brought my attention to BFSI as a sector. I was more focused on PSU banks. I still am, but then he gave me some perspectives. Thanks, Amarnath. And we look at this, we see how Bank Nifty by Nifty ratio chart is at the lower end of the channel, of the regression channel, multi-year since 2000, since the year 2000, right? And extremely attractive risk reward. Valuations are reasonable in the banking space, both in the private banking, because they have underperformed for the last, ever since COVID. They have underperformed PSU banks massively. And of course, in the PSU bank space, where we are going to see a renewed, we are seeing improved balance sheets and a pickup in credit growth, right? And the valuations are still reasonable at about 1.5 times price to book for PSU banks, except SBI, which is very, very reasonable, right? Where your private banks or the banking index is trading at what, 4 times price, to 2.5 times price to book value. So that is pretty reasonable, right? So banking looks very attractive. It has underperformed since before COVID, and except for a couple of bouts of outperformance, but largely underperformed. And there is a lot of scope for it to outperform Nifty, to move up to the upper end of the channel, of this regression channel. So extremely good risk reward. PSU banks, my favorites, along with infrastructure. Multi-year downtrend being broken now, back into this range. A lot of way to go. Very attractive, right? So these are some sectors: infrastructure, bank, BFSI, within it PSU banks, particularly automobiles and pharma, of course. They remain good. These are some pockets where there is still some value, attractive risk reward. Rest all look pretty expensive at this point in time. So our equity outlook: earnings growth remains strong, driven by margin expansion, but sales growth is slowing. Slower sales growth will soon start impacting profit growth also. And we don't see a significant improvement in sales growth because the global trade and global GDP's growth is slowing down. So finally, earnings growth has to slow down before the next phase. And that would mean that these kind of valuations are not sustainable. So we may look at either a sharp price correction or a time correction over a period of time. Any which ways, Nifty returns in the near future are not going to be very attractive. So we have already spoken, we need to diversify. Couple of sectors which are looking better: infrastructure, capital goods, pharma, PSU banks. Mid and small caps look very expensive as compared to large caps. Risk reward is not favorable, particularly in mid caps. Small caps may still have some room to go, but we can't take a bet on that. Better to be focused towards large caps. Uh, Mutual funds, domestic mutual funds, and investor flows have supported FBI outflows, countered FBI outflows. The key risks are rising crude oil prices. If the situation escalates in Middle East, oil prices will rise again, and that will be a big risk for India. And the second risk is higher interest rates for longer, because that means lower capital flows from the West, and that creates problems, right? Our investment strategy, our stance on equities is neutral to underweight. It is time to bring down our return expectations from equities. We have been giving 15%, 18%, 14% return expectations to investors. Actually, it has to be brought down to 9 to 10% at these valuation levels. We can bring it back to 14% levels if the valuation correct to say 16 P, but not at these levels, right? So bring down return expectations. It is important that you manage the expectations of your clients. You make the client believe that he can get 15%. And if you deliver 14.5%, the client will fire you. But you make the client believe that he's going to get 12%, and then you deliver 12.5%. The client will be very happy with you. It is all in life, is all about managing expectations. Please focus on that. Diversify your asset allocation as fixed income and gold look equally or even more attractive. Rebalance equity allocation towards non-market linked fixed income and gold. Aggressive investors can add on corrections as valuations get cheaper. Keep an eye on the P ratio, etc. Moderate and conservative investors should go for dynamic asset allocation or balanced advantage funds and multi-asset allocation funds. Some sector funds that can be looked at by aggressive investors, even moderate, are pharma, infra, manufacturing, and BFSI, banking and financial services, particularly those focused on PSU banking space. This is our outlook for equities. Quickly, fixed income, not much here. Uh, Yields came back sharply to around 7.25% levels over here after spiking after the RBI monetary policy, where they said that they will do OMOs in October on October 6th. They came back, led by whatever is happening in the US. Indian yields remain very well anchored in this narrowing band, right? Not yet breaching this upper downward sloping trend line. So very well anchored. Great job done by RBI. Our spread with US 10-year G-Sec yields is at 2.75%, amongst the lowest since 2006. But at the same time, our inflation spread with US has also reduced to 1.17%, right? So this is comfortable at this point in time, 2.75. Even within our policy rates, if you see, this orange line is US Fed funds rate and the blue line is our India's policy repo rate. If you see, this is since 2001, how this gap has been widening and narrowing at different points in time. Right now, this spread is at 1.17%, right? Which is the lowest in history since 2000, 2001. This is the lowest. And this is, so India hasn't been raising rates so much. So if US now, the next thing, the flip side is, if US cuts rate by 200 basis points from 5% to 3%, India will not be able to cut because it hasn't raised them so much, right? So maybe even if US yields come down by, say, take the recent example now, US rates have come down from 5% to 4.5, 10-year G-Sec yields. India fell from 7.4 to where? 7.4 to 7.25, only 15 bips. US came down by 50 bips. So this is what. So there are people who say US will cut rates and that will be God's gift to mankind. But the point is, the impact in India will be lesser because we have not raised rates much. The spreads have narrowed, and they will narrow further as our inflation spread narrows. So these are different dynamics. The older rules are being broken. Be very careful, right, about going for narratives. Our yield curve is flat. US is negative, started going negative again. Our yield curve continues to remain flat. Value is in the 5 to 8 year segment because beyond that, the yields don't increase even though duration risk increases. Below 5 years, the yields reduce very sharply because the curve has kind of flattened, has steepened. So basically, the sweet spot is this 5 to 7, 8 year tenure, which means what funds are better? Floating rate funds, banking PSU, corporate bond, medium duration. With a 3 to 5 year maturity, they carry a better risk reward, right? FPIs have been investing very well in Indian debt for the last 8 months. continues in November. In the first few days, they have invested 4,700 crores, which is very bullish. Arbitrage funds, it is important, please pay attention. The last 3 to 6 months have done very well for arbitrage. They have outperformed. These returns are as on October 31st. And if you see the 1 month, 3 month, 6 month return, uh, financial year to date, since April returns, 1 year returns in arbitrage funds have been far better than ultra short, liquid money market or overnight funds, right? Last month, we informed you that the yields in arbitrage funds and the spreads, etc., are very attractive at 9% plus as compared to money market funds. Whatever happened in October, the sharp fall in equities reduced the futures premium, which means the arbitrage fund spreads have narrowed down to 7.2 to 7.3. And the remaining part, 30-40% debt that they have, is also bearing similar yields, right? So the blended portfolio yield of an arbitrage fund before expenses is about 7.2, 7.3. Correct? Now, arbitrage funds carry a expense ratio of 1%, which means post-expense returns that we can expect is 6.2, 6.3. As against that, money market, liquid or ultra short duration funds, where the expenses are also lower and the gross yields are at about 7.5 to 7.7, right? They yield similarly, right? So net after expense yields for money market or ultra short term debt funds is 6.4 to 6.8. For arbitrage fund is 6.2 to 6.3. Correct? For liquid funds, it's about 6.5 to 6.7. So this arbitrage fund, which was very attractive last month at about 7.5 net YTM, is now less attractive. People have a habit of looking at last 1 month, 3 month, 1 year returns and then investing mindlessly. Don't do that. Now on pre-tax returns, arbitrage fund is slightly less attractive than liquid or money market funds. And if the markets continue their bull run, then the premiums will keep on expanding, which will dent the returns of arbitrage funds in the short term. Right? Later on, again, there will be a time when the spreads would be higher and we will have a better opportunity. So it has to be a tactical play. Right? Right now, for next 1 or 2 months, arbitrage funds are less attractive as compared to liquid funds or money market or ultra short duration funds on pre-tax returns. If any investor is in 30% tax bracket, then in terms of post-tax returns, arbitrage funds will still be better, but not for other investors. And don't promise them the moon that last month you got 7.5% return, so this month again you are going to get it. No. Right? So tone down your expectations and pass it on to investors so that they are better prepared and then they don't fire you. Right? So this is the debt fund metrics that this helps you choose the right debt fund for your client. Basis is investment horizon and net YT. I believe it's going to be very helpful for you because it also shows the credit risk, the interest rate risk, everything. Right? So be careful with arbitrage funds. If you are already invested, don't worry, no need to exit. But if you are looking for fresh investments, tone down your return expectations. Maybe 1 2 months down the line, when the markets have become more bullish, we will again get better spreads, right? But not right now. Manage the expectations. In fixed income, it is better that you focus on non-market linked debt also, like bonds, secondary market bonds, where you can lock in the yields, where the prices don't fluctuate every day, or at least you are not impacted by those fluctuations, like FDs, corporate FDs, secondary market bonds. It is important to have some allocation, a reasonable allocation to that part, because the market linked part is going to be volatile. A debt mutual fund, if you see here, will at best, the net YTM will be 7%. The best case, floating rate and corporate bond, right? Everything else is less than that. Now, if there is an M2M loss, then what happens? Say if there is no M2M loss, even then you get 7%. Forget about M2M gains. Then no, yields will not go down and remain there for long. Even if they dip by a few points, they will come back and you will not be able to book profits so swiftly because of taxation and exit loss. So you can't trade tactically in debt mutual funds. So keep your return expectations at say about between 6.5 to 7% from debt mutual funds. And the taxation advantage is also gone. So doesn't a corporate FD at 8% plus or a triple A or double A plus rated paper at near to 9% look better? Taxation is going to be the same. Yes, on these papers you have to pay tax every year. Over there you pay tax when you book profits and all that. I've been through those stories. But the gap is almost 100 to 200 bips between non-market linked and debt mutual funds. I'm not saying you exit debt mutual funds. Hold on to them. There is always a place. But what I'm saying is do allocate some money to non-market linked debt also to give a better experience to your client, right? Because otherwise, tomorrow the client will come back and say to you that, see, my bank was giving me 7.5. I did not do that. I invested in debt mutual fund where I have got only 7% or 6.5. You will not have an answer to give to your client, right? The primary thing is don't lose the client. That is where I'm helping you uh, over here, right? Rest is all very clear. Don't go for credit risk. The credit spreads are not at all attractive. They don't reward you for the extra credit risk taken, right? Whatever credit risk fund attractive yields you see will all be taken away by the net expenses, right? After expenses, the net YTM of credit risk funds is 6.7, lower than that of floating rate funds, banking PSU rate funds, and corporate bond funds. So be very careful. Don't look at the gross yields and invest. Look at the expenses also. Gold. Again, same story. Stagflation, high inflation, high interest rates, slower growth. That's going to be the story worldwide. What assets perform in this? Broad commodities, which means metals and energy. And best is gold, right? Gold has taken support and bounced back very strongly from this level that we highlighted last month, 1800, right? And it has gone up to 2000, came back to 1950 now till yesterday. Let's see what it does. Now the support has shifted upwards to $1,900 per ounce. Let's see what it does over here. We remain extremely bullish on gold. This is gold in rupee terms. Again, the support is very strong at about 56,700. It is at about 60,000 now, coming back from almost 62,000. Let's see, maybe consolidation for some more time, and then it breaks out once risk off sets in again. But remain very bullish on gold. This is Nifty versus gold. So if I ask you a question of what should your allocation be between equity and gold, then what help? How would you know that? So this is Nifty 50 ratio chart of Nifty 50 divided by gold in dollar terms. And this shows the relative attractiveness. So you see if this ratio is at the upper end of this regression channel, long-term regression channel since before 2000, then gold becomes more attractive. That means Nifty is getting expensive. After that, it corrects, right? Look here, what happened. It corrects, equities correct very sharply, whereas gold outperforms equities, correct? And vice versa. When it is at the bottom end of this channel, equities become more attractive versus gold. And after that, there is a phase when equities, look at these phases, when equities do very well or outperform gold massively, significantly, correct? So we have spent a long time at the upper end of this band, equities versus gold. And it is time, it has formed a triple top or a head and shoulder pattern, which is technically a very strong pattern. And I believe that it should come down, which means there is an extended period of gold outperforming equities. That does not mean that equities will crash. It could very well mean that equities give you 8% return and gold gives you 10%. Correct? Even then, this ratio will come down. Or if equities fall by 20% and gold falls, but only by 10%. The point here is gold will outperform equities, whether on upside or downside, or not even will, may. The probability is very high. The risk reward is in favor of gold. So it is important to have a reasonable allocation to gold. It can be through multi-asset funds, which generally have 12, 15, 20% allocation to gold, or you can buy gold sovereign bonds, or you can buy gold savings funds or gold ETFs, right? But have a material allocation to gold in your client portfolios. This should work out very well. We have already seen that happening in the month of October, and this will keep on happening. See the last this period from September 21 till now, gold has intermittently, in phases, it has outperformed equities very well. So have a balanced allocation. So that was it from my side. Uh, I can't stop myself once I start speaking on equities. But let's go to the Q&As. Sorry, it's been 1.5 hours. Kailash Pandey, I have a question. Yes, Mr. Pandey, please type. You can type your question. Sanjay Sani, sir, I hope goal-based investment and SIP either in mid or small should be continued. Sir, your valuable advice. Sanjay, uh, it really depends on when you need the money. There is empirical evidence done by a research house which shows that when past performance of gold of mid or small caps, last 3 year returns of mid or small caps are very high, sorry, then the next 3 to 5 year returns from them are actually in single digits. So we need to relook. If your goal is more than 5 years away from here, and you are investing through SIP, and the goal again is more than 5 years from here, then you may continue. Otherwise, it is better to rebalance, right? Rebalance. Don't get out of equities. Shift some part of it to large caps. There is no harm in doing that. I hope I have answered your question. Thank you. There are no more questions left. We have already taken almost 1.5 hours, more than that. Parth, closing comments, and thank you to all the attendees here.
Before we
Sanjeev,
let you all go, yes, sir.
yes, please continue.
Before we let you all go, let's give a big thank and clap to Mr. Alok Aggarwala and enlighten us on our important topic. Again, I want to thank you for the esteemed participants for the taking time out for their busy schedules to be there here. Thank you joining us a wonderful session. Good morning,
Thanks.
everyone.
Thanks, Sanjeev.
Thank you, sir.
Thank you, Vijay. Thank you, everyone.